So let's talk about now about obtaining financing in Florida, right? To buy a home, because a lot of people, when they come to Florida, um, you know, they want to have a mortgage. Some people want to pay cash. Tell me about, in your mind, the pros and cons of each. And then also, let's talk a little bit about, we can talk about after that, talk about how you've helped my clients who were retired and didn't think they could qualify for a mortgage, get a mortgage and a substantial mortgage at that. So,
Sure.
sure. Yeah,
So I think the pool of buyers that need a mortgage, right? So that's need a mortgage, just should think about leveraging their money within the mortgage. So a lot of clients call and say, I got to do 20% because I don't want private mortgage insurance. And just thinking about it makes sense, an extra cost. But mortgage insurance rates are so low right now because the foreclosure rate has been so low for so long. The premium that you can leverage your money by doing 10% down, let's say instead of 20 and on 700,000, that's 70 grand in the bank to only pay, if you have good credit scores, maybe $115 more a month. In my mind, I'm like 70 grand in the bank, 115 bucks a month. That's a no brainer.
sure.
So that is one pool client, something to think about is make sure to look at leveraging your money. And that's where we can get the numbers and you, of course, can review with them and say, here's what we'll do with it. And that's why it's nice to
Sure.
have financial advisors involved. Then you have the mixture, if I'm following the question, right, is now we have, should I get a mortgage or pay cash? Or should I leverage more of my money on a mortgage and keep more in the bank? And so I think that goes down to philosophies of who the client is and also their financial advisor. For me, my philosophy is if I can outperform my debt in the market or in my investments at a certain number, then I'm going to leverage my money and make money because of the simple concept of compounding interest, right? And a lot of people miss
Yep.
out on that compounding interest. And I have seen it work in my life for so many years that I will tell clients, this is my personal philosophy. This is, you review in your family with your investment team. But if rates are at 6% for simplicity's sake, and your investor has been averaging 9 to 11%, right? And you're okay with, and this is all prefaced with, you're okay with the monthly debt, then why not go make your money in the markets and keep your money growing? Especially if you're a young family and you're building wealth. I get a lot of questions of, hey, what if I pay an extra payment a month or a year or whatever? And I say, are you maxing out your 401k? And they're like, no. Well, 401k, you get a tax deduction the year that you put the money in. And a lot of companies match between 2, and I just had a client matched at 8%. So on 17.5, she might get a benefit of over 50% on her money that year. So using that kind of illustration and then growing it from there, depending on the client, is what I look at. So when rates were 7 to 8%, which was only, not too long ago, and they've come down, but then I start to question, is it worth it all? Is it worth it to maybe
Sure.
gain 1 or 2% and have the risk of having a down market and going negative? Then I could understand the cash buyer saying, I'm just going to pay cash and I'm going to wait to see what happens and I'll pull the money out.
Right. I mean, I think, and that's the way the philosophy at Van Leeuwen and Company is that at 6% here, we clearly believe that having a mortgage is the way to go, because over long periods of time, as per your point, you can compound your asset, even if it's, the S&P does a little bit more than average of 9% a year. So that's clearly 3% more. But also what it is, which is super important, especially if you get a fixed rate mortgage, right? Just due to inflationary pressure, inflationary costs, the true cost of that mortgage declines every year because of inflation. So that's why another positive why you should get a mortgage because of that inflation cost and compounding the money. Again, but it's all qualified. Like some people are very opposed to debt. Okay. Got that. Understand. But this is good debt. This isn't credit card debt. This is a good debt to have. And of course, they have have to have the cash flow to make the payments, right? So
I I think that's a really under talked about point is the inflationary. So you're locking in that $300,000 in debt at today's price and paying it down on the future cash flow of the inflation value. Is that what you're basically
yeah,
saying?
basically, because if you think about it this way, right? Not that people hold their homes necessarily for 18 years, but if you think about uh, a home and you're going to own it for 18 years, and let's assume inflation is 4%. So that old rule of 72, but now we use it in reverse, right? Basically is that debt was worth 300. Now, based on that inflation factor, it's really only 150 in today's real money. So that's how you've worked both angles for your betterment. And
Yeah.
that's why you see people, yeah, you have to be judicious with using debt. Yeah, we always know that. And again, that's a personal issue. But again, that's something to think about, especially in a lot of cases today. We have clients with portfolios that have capital gains in them still, even after this little downdraft here this month. So what happens is they want to buy a home for cash, they have to liquidate assets in their portfolio, which causes capital gains. So they're paying an extra 20% on that money that they're generating. So that's why you have to think about it, in terms of the overall. So I think that's why, with a good mortgage person, and like you said, whether a financial advisor or a CPA or someone to kind of guide you, it's helpful in that regard.